Hey, all you beautiful people. Micah Roquiero here, Mr. Utah Real Estate. We're going to do another podcast, and we're going to talk lending today. I got with me Holly Fillmore from Preferred Lender. Did I get that right? Preferred Lender.
You got it.
And she's going to talk about some of the misconceptions we have in lending and when borrowers borrow and some of the misconceptions they have. 11 of them, not 10, 11 misconceptions. But before we get into that real quick, don't forget, subscribe to my channel, give me a thumbs up, comment. If there's any questions you have for either one of us, leave it in the comments. We'll get right back to you. I'll leave both of our contact information in the description, so you can go ahead and scroll down and get that. And if you have any questions, contact either one of us or give us a comment. But anyway, Holly,
yes,
you with Preferred Lender. Give us a little bit of information about yourself, about Preferred Lender, and how long you've been doing this. And
So I originally got my license in real estate and was always super interested in this space. Discovered early on that I love working with buyers, and what better place to do that with mortgages, because you're only working with buyers. I mean, and not to say I don't like both sides, but I just really loved that part. Like, it's super satisfying getting someone into a home, especially it's this dream home, first time home. We've done that before, and it's just wildly satisfying. Got approached by Preferred Lender a year ago is when I started with them, and have been in this office with you since that time last July. Preferred Lender is a little unique. Well, not unique-ish, where we broker everything out. We feel like clients have better access to different products, different pricing, brokering versus in-house lending. It's why we chose to go that route. And again, in this office full-time, and then we are in and out of other offices as well. So
that's one thing I love about Preferred Lender too, is because you guys come from not just the buyer side, but the agent side. So you make it very easy for agents, because you've been in there. And I believe the owner of the company is also a real estate agent and in the lending business as well.
Yeah. I was going to say, I think about 50% of us were licensed in real estate first, which I've found is more and more common the more I talk to people, that like we have someone in warranty. They're like, oh, I used to be a lender. We have someone in title that they're like, oh, I used to do a lender. So I feel like it's common that people kind of jump inside of this like vertical until they kind of find that niche where they're like, yeah, I really, really love this. But I think it provides a greater level of understanding in the transaction where I'm like, I know what it takes on the real estate side to take them from point A to the finish line. And so we wanted to create a company that was more minded towards agents, and not that diminishes anything with our actual borrower clients, but we wanted to create a platform that made it easier for agents, where there was that better level of understanding and just trying to buoy our agents up a little bit more.
Love it. I actually tried to get into the lending side a few years back. I went and got my mortgage license, and I had it, and I tried to get on with a few different companies. But unfortunately, I got it during the 2020-21 period when everything was so low that refis were going through the roof. And they didn't want to bring someone on who was brand new. They're like, no, we need someone that can go to work right now and do these refis. So I had a hard time. I couldn't find anyone that would bring me on as a newbie. So I renewed it the next year, and then same thing. Like, you know what? I guess it just wasn't meant to be. I'll stay in the real estate side.
See, I don't know.
I'll
come join us now.
Yeah, now.
Hop on.
Unfortunately, I let it expire, and so I was like, it was. I got it, and then it expired. I had it for 2 years. It expired.
But do you feel like even that, like you probably have a better understanding now with even like your borrowers, where you can bridge that gap a little bit better, where you're like, you have that better level of understanding, and annoying that you had to like do all the studying and take a test and pay the fees. For that understanding, but I think it just makes you a better agent.
It did. Yeah, it did. I learned a lot of different things, a lot of new things that I never really understood. I knew and didn't really understand, but then I also learned a lot of things I didn't know through that. And so it was a great learning experience for sure. So it wasn't I did it for nothing. I did it.
And I really do. I think it makes you a better agent just because you have more of that level of, I know where this is at. I know where this is coming from.
And that's one thing, too, with my clients, my customers. They'll ask me a lot of lending questions, mortgage questions. And, of course, I'm not the expert in that field. I'll refer them to my lender or your lender.
Yeah.
And but I still get a pretty good understanding of it. And again, talk to the expert, talk to the lending expert. I'm the contract expert. She's the money expert. But anyway, so let's get into some of these misconceptions that first-time buyers or even buyers in general have. And we've got not 10 again. We've got 11 misconceptions.
Very thorough.
So Holly spent some time to go through these and kind of look at these up and with your personal experience. You hear this all the time as well. So the first one that we're going to cover, the first misconception, I need 20% down to buy a home. A lot of buyers will think, I don't have enough down payment money. I don't have 20%. 20% down. That's a big misconception.
Yeah. Yeah. So this was actually news to me. I didn't realize how many people had this misconception. It's over 60% of people believe I need a 20% down payment. And that's even with people that have already purchased a home, which is funny because the average individual doesn't put 20% down.
Yeah.
So it's kind of funny. But that's the awesome thing about real estate is 20% is actually very rare that people put down on a second home. If they're selling and then purchasing again, it's a lot more common. But it's not always even like your best option. So with a 20% down payment, you get to avoid mortgage insurance, which is why everyone is like, I need 20% down. I don't want that mortgage insurance. What most people don't realize is mortgage insurance, especially if you have good credit, is going to be very minimal on your monthly payment. So even if you did have 20% down, you don't think you're going to be in this house long term, your money may be better utilized not in equity in this house. It could be better utilized in other investments, like instead of pulling it out of an investment, or like it may yield you more in the long run. But first-time home buyers, FHA loans, you can go 3.5% down. That's the most common one that people use is going to be a 3.5% down payment. I prefer a conventional first-time home buyer program. It's 3% instead of 3.5% down, and then your appraisals and inspections are a little more forgiving than an FHA, and you don't have that. With an FHA loan, you have an upfront mortgage insurance. So I like the conventional route a little bit better. Say you're not a first-time home buyer. 5% down payment is all you need on a conventional loan. So again, I just did this because I did it for another thing that I did recently. But if you have a $500,000 home, which average price in Utah is right around that point, that changes your down payment from $100,000 to $25,000, which just opens up the doors substantially for people. And so it's like, let's focus on that portion. And again, that's 5%. So you go 3 or 3.5%. You're slightly less than that. Let's focus on that. That's a manageable and attainable goal. Because a lot of people, if you're just starting out, this 100 is going to be a lot harder to reach, where it's like, yeah, let's get you into this pocket. Let's start building equity in this house now. And then 3 to 5 years, guess what? You're contacting Micah again. You're going to go do it again, but now you're going to have built-in equity in this house.
Yeah. And then with that 20% down, maybe it's better instead of putting onto a house, maybe you pay off a car or something, and now you have that maybe $500 extra cash flow a month.
Yeah.
Versus bringing the payment down maybe.
So someone with good credit, your mortgage insurance is going to be under $100 a month. I've seen people with less than ideal credit have really expensive mortgage insurance. And then we go the route of, okay, can we get you into an FHA versus a conventional? Because the conventional, it's going to hit them harder. And we kind of just explore all of those options and make sure, okay, this is going to make the most sense for you. But I think people have this understanding of this is going to be the best case scenario for me. And it's like, let's like really look at everything.
Where they sit down with you and kind of go through all the scenarios and figure out what's the best route to go.
Yeah. Yeah. Because sometimes, like I said, sometimes it's not in your best interest.
Yeah.
Because again, if you're pulling it out of a retirement account, but you have this liquid 25 sitting here, it's like, I don't know, maybe just let this continue building on this arm and then we'll just use your liquid.
So we're 20% down. So, I mean, I know, so it's for an investment property, right? Investment properties, you're going to need more down payment.
Yes.
Right? But if it's your personal residence, 5% conventional, 3.5 FHA, and I believe, correct me if I'm wrong, there's also no down payment programs as well.
Yeah, absolutely. So in the state of Utah, we have Utah Housing Corporation, and that's the one good thing about being a broker is we broker with all these different lenders. So Utah Housing is one of my, honestly, in the state of Utah, I think is the best down payment assistance program. It's not the only one. Counties have specific programs, but they have really strict limitations surrounding their like grant money and down payment assistance money. Utah Housing is the most straightforward. It's the easiest to use. It's the easiest to like access and be accessible for the most buyers. And that's going to be a down payment like 100% covered. So we've had buyers where they aren't bringing anything to closing, yet, even with like their closing costs.
That's nice.
The one thing with a down payment assistance program is there is a payment attached to that. It's going to change your monthly payment, around $120 to $150 a month, depending on how much you take out for that down payment assistance. But it's a great program. There's also other lenders that will allow 100% financing. So your interest rate is affected a little bit. You're maybe paying a little bit more on an interest, but instead of having two loans, like a Utah housing loan, you would have your mortgage and then you'd have your down payment assistance. And they're acting as two separate liens on your house. There's other lenders that will let you wrap it all into one. So you'll do 100% loan to value financing on this house. And again, your interest rate's affected a little bit, but sometimes that's the better route for people because they're like, I don't want these two separate things. I don't want to make two separate payments. I want to make one payment. And we're like, okay, let's explore this.
Too much to think about. I'll just put it into one.
Yeah, throw it into one. But then you have other people that are like, no, I want the two because I'll just pay this one off as fast as we can. So instead of saving this money and waiting to get into a house, we'll get into the house and then just start like paying our down payment, but we're already living in the house, which is a really sweet option.
Yeah. So 5% conventional, 3.5 FHA, Utah housing.
No down payment.
No down payments. So you say Utah, real quick. I know many lenders are licensed in multiple states. So that Utah housing, that's just a Utah only thing.
Yep.
Are other states have this too?
Yeah, there are state programs on like every level, right? In every other state. I'm only licensed in Utah and Idaho. You'll have other lenders that are licensed in 5 to 6 states. Because I'm in this office so much, I didn't want to dilute my time as much. That doesn't mean that I won't continue to get licenses other places. But I like to hone in on this area and get to know it a little bit better. But again, inside of Utah, you have county programs. And you'll have some cities have their own programs. And so I think that's really common in other states. Again, if you have this big entity that has access to programming for the entire state, I think you're going to get a more consistent result. And it's going to be usable for more buyers than some of these like county specific programs. But I think it's going to be really common nationwide that there's going to be these programs. And again, like that, like 100% loan to value with lenders, that's going to be statewide, right? Like countrywide, where we have, so for instance, what's a big one that does that? UWM. Everyone knows UWM. They'll have a program. They lend in all 50 states. Right. So that program is going to be accessible to everyone.
Okay. So the different down payment amounts, we're not going to go too far into this part of it, but there's also grants, right? And you talked about different counties, different cities have different programs. There's also grants all over the place for multiple different things. We won't get too into that. That will take us forever to go through all the grants.
Yeah.
But if you ever want to find out about grants, contact either one of us and we'll put you in the right direction to find out what grants are out there, what grants you might qualify for.
Yeah. And how to look at a grant as, okay, is this an actual grant? Like, is this money in my pocket that's free, I don't have to pay back? Or are they using the term grant as, okay, it's really actually a loan?
Yeah.
And so that's, I mean, we could have had 12 bullet points because that's the whole thing where it's like, is a grant actually a grant?
Yeah, and there's different ways they set them up too, where you don't have to pay anything back until you actually sell the house or pay it off, and different scenarios. So again, way too much information to get into right now.
We can do that on another one because I'm like, we would have 12, 15 points of that.
Yeah, there's so many of them out there. So many different ways we can go on this. That, again, reach out to one of us if you're interested. 0 down, 3%, 3.5%, 5% grants, investment properties. It's all
Yeah, it's going to look different for everyone. It's going to be more advantageous for certain people to do it one way versus another, which is why it's so imperative that it's like, talk to someone at the beginning, whether or not you're looking, where it's like, let's start talking and then let's figure out what's going to make the most sense for you, because it's going to be it should be very individualized. It's not always looked at that way.
And when you say individualized, it's going to be different for everybody. It depends on your qualifications, your credit scores, your debt-to-income ratios. First-time home buyers, I'm thinking, have different programs than people that have bought before. So many different scenarios. Again, contact us to figure that out.
Okay, segue here a little bit. You said first-time home buyers. This is also a big one. So we talked about like a 3.5% down or a 3% down for these people who qualify for first-time home buyer loan programs. What most people don't realize is if you have not owned, so even if you've owned in the past, you haven't owned in the last 3 years, you're most likely eligible to do a first-time home buyer program again.
Okay, that's good to know.
Yeah. So that's a lot of people that are like, oh, can I even use FHA? And I'm like, well, anyone can use FHA. Can you use a first-time home buyer program right now to get that 3.5% down? I don't know. Let's look at your past. If you haven't owned in the last 3 years, let's just do that again.
That's good. Yeah. So, all right, let's go on to the second one here. So that's number one.
We could do this forever.
You don't need 20% down.
Yep. Moral of the story.
Moral of the story. You don't need 20% down. So many different ones from 0 to till you can go 100% if you wanted to, but yeah. Which is a cash buy, by the way. All right, number 2. If I put more down, I'll automatically get a lower interest rate.
Yep. So interest rates.
Misconception, right?
Yeah, interest rates, I mean, they do vary slightly. What people would be surprised to know, so when we price things out, sometimes when someone has 15% down versus 20% down, or 10% versus 20%, because lenders are capitalizing on mortgage insurance, right? Under 20%. Sometimes you'll actually get a slightly higher rate with 20% down.
That's good to know.
Again, it's going to be marginal. The biggest impact on your interest rate is going to be credit score. Like, you'll have these national average, like, we live in Utah, you drive up and down I-15, there are tons of more, like, billboards plastered with interest rates. It just doesn't mean anything until you really start going, because the bulk of interest rate is going to be affected by your personal credit profile is going to affect that more than any. And then again, the price of your house, how much money you're putting down, it changes things.
So real quick on the billboards, you talk about those billboards, and I see them all the time. Those rates you see on those billboards, that's what I'm going to assume. They're going to find the lowest possible rate for the highest possible credit score, and they're going to put that lowest one, and that's probably what, 5% of the people buying homes, maybe?
Maybe. Well, and sometimes they're like, that's based off of someone paying X amount for their rate, right? Like, that it's not something you're coming in and you just have access to. It's something that
you actually have to pay for it.
Yeah, like a lot of times, it will be something that you're paying for.
And if anyone's not familiar with this, you can buy rates down, but if the buyer's buying it down, I hear it's pretty expensive to do it, and not always worth getting that lower rate with the amount of money you have to put into it. That same money could be put somewhere else to give you better affordability, maybe monthly affordability, or pay off some debt or whatever. And
or if you're looking at and we could lump this into that first question. If you're looking at it with like even your down payment, right? So if you're buying a home that is existing that needs some work, well, I was talking to some people that flip the other day, and I said, okay, how much work can you get done? So you're looking at the $25,000 to $100,000 difference, right? Like, how much work can you get done with that?
Mm-hmm.
What is it? $75,000? No.
Yeah. Yep.
Like, and it's like, we can get it. We can do that. We can do the whole house with that. And then you're like, well, Sam, you have your equity anyways. And then at that point, you just refinance. You're going to get a better rate. You're going to get these things. So it's like, that's why it's important, again, as you're talking to your agent, as you're talking to your lender, like kind of going through all of these different scenarios to make sure, again, okay, how do we get the best rate? Are we okay with this rate for now because we know something better is coming?
So the more money you put down doesn't necessarily get you a better rate.
Yeah.
More times than often, it actually doesn't get you a much better rate.
And again, it's going to be marginal, but it is going to be your credit score. Like, They look at interest rates. They almost put them in buckets. An FHA loan, you aren't hit as hard if you're in the 600s and you're going FHA, you don't take as much of a hit as like a conventional. So if you're a conventional client and you're trying to get into a home and you're in the 600 range, your interest rate's going to take a decent hit if you go from those 700 scores into the 600. Where the FHA scores, it's not going to matter as much. Which again, then you're talking to someone. Okay, this is where my rate is. What's my best option? Okay, well, let's try and get you into like I said I like the conventional 3% down, but I don't like conventional 3% down with someone that has a 630 credit score. We're looking at an FHA only for them.
Right. And with today's market too, talking about more money down or money buying rates down. With today's market, it's really a buyer's market right now. Homes have been sitting on the market for longer than normal. The higher rates right now, right? So buyers, instead of putting your own personal money down to buy a rate down, we can now ask the seller, I'll help you do this. We'll ask the seller, contribute me, give me some money because you want to sell your home. I want to buy it and you really need to sell your home. So give me some help, give me some money, and the seller will do a temporary buy down, which can help in the short-term future until rates drop, and then you can refi and 10 on. So short-term buy downs, you can buy it down 2 points, 3 points, depending on how much you get for that. Yeah. So you can save. You can go from, say we're at 6.5 right now, you can go down to 4.5% with the seller's help. So there's ways. You don't even have to put your own money down on this. There's ways that we can get this done for you.
Yeah, no, it's really cool, and we're in a market like you said. Like I think of the loans that I've done. I'd say 98% of them have either some type of credit that's going towards an interest rate to lower that interest rate, or covering all the closing costs, or just those fees. So it's an, again, advantageous time to buy. Call Micah.
Yeah, so we actually just did a deal together where the buyer did ask the seller to contribute funds. They did do the 2-1 buy down, saved them $600 a month for their first year. Yep. Which was the point where it's like, yeah, we can do that. Let's do that. And that's what helped them make the decision to go ahead. Yeah, we can go ahead and afford to buy a home right now.
Yeah, we want this. We want this particular one. Okay, how do you make this happen? And again, you still have to qualify, right? Like you're going to have to qualify at that higher interest rate. So if today's rate is 6.5%, you're going to have to qualify at 6.5%. But if we can then utilize this lower payment to ease you into home ownership, hey, I'm going to get in here and my payment, instead of being $3,600 a month, it's $3,000 a month. Right. And I'm just going to pocket this $600. I'm going to act like we're paying my whole mortgage payment. We're going to pocket this for the next year. And that's great savings.
And when rates do come down, you refi into a lower rate, and the time is right, and you get into that lower rate, a permanent lower rate. Any leftover money that was used,
put back in your pocket.
Puts back into your pocket. So you're getting a great deal.
Yeah, and that is, I will use a caveat. That's with a temporary rate buy down. If you do a permanent rate buy down, it never comes back to you.
Right. Yep.
But
so again, there's differences again. So many different ways to go. That again.
If rate is your main concern, then let's have a discussion.
Yes.
Because there's a lot of things we can do.
And you may wonder, how easy is it to get money from sellers? I'll tell you what, we'll get it. I'll get it. Either there's different ways to go about it. Of course, we're going to target homes that have been on the market a little bit longer. They're going to be more willing to contribute because they got to get it sold. It's been on the market so long already. Let's just do whatever we can to get this thing sold. It's a lot easier to do that than someone that just put on the market and it's been there for 2-3 days. Yeah. But there's different ways. It depends, again, on the seller, how fast they need to get it sold. But I promise you, I will get you that buy down. So far.
Yeah, I would say do it.
Every client I've done it so far that needed it, we've done it. So
yeah, and again, it is what's important to the clients, because sometimes what's more important is actually, can I get my closing costs covered?
Yeah.
Like, I'm okay with this mortgage payment. Let's get the closing costs.
And a lot of time with closing costs, you'd rather keep that in your pocket, because now you're going to go buy a new couch. You're going to go buy a new bed set. Everyone gets excited to get their new home and they want to go house shopping. So yeah, we'll keep the money in your pocket, and we'll find different ways to get
however it looks. Again, which is why this is such an individualized process. Like, I think people look at home buying and it's like, oh, we're all the same. It's like, no, let's have it be very individualized.
Everybody's story is different. Everybody's needs are different. So just because one person did it one way, your friend did it one way, doesn't mean you need to do it that way as well.
It's oftentimes not in your best interest, where it's like, that worked for them. let's look at something different for you.
Great. Love it. Love it. Sorry. Let's go on to number 3 here. Let me put my glasses on. I try to read these blurry things here. All right. Number 3. The number 3 misconception. I can't qualify for a mortgage if I have any debt.
Yep. So this one's easy to combat, right? So when people look at their monthly debts, oftentimes, even before they filled out an application, I'll have conversations with clients and they're like, oh, well, I have a $30,000 car loan. Okay, here's the thing. We don't look at the $30,000 car loan. We look at what's your monthly payment. So the way we calculate your qualifying number, your qualifying income, it's based on a debt to income ratio. It's basically all of your monthly liabilities, your debts that you're paying. So again, not this total balance. So your $5,000 credit card balance, we're not looking at that. We're looking at the minimum $100 payment. Again, I'm not saying go out and get debt because again, you have to pay that off.
Especially don't get debt if you're under contract already.
Yeah, don't get debt and don't go open new credit cards.
When you're under contract, don't go open a new credit card.
Don't buy a car. Don't go to RC Willey
or just don't do anything until you talk to Holly first.
Yeah, because we will get people that they're like, well, we wanted to buy a house, so we went and opened it. We thought we needed to open up these new cards, so we had these more credit available, and it actually ends up hurting them because their age of their credit then just got.
Which is actually the credit card is another misconception, I believe.
Oh, yeah. So we can get to that.
The credit card thing.
But yeah, moral of the story is you're looking at your monthly payments. So you'll take, if you make, again, I always go easy numbers because I don't like doing math in my head. You make $1,000 a month. You have $100 worth of monthly payments. It's your monthly income divided out by your debts. And that's your debt to income ratio. So a debt to income ratio on an FHA loan, you can go up to, I tell Micah, I get into the weeds. So just bear with me for 2 seconds and we'll get there. When you buy a house, you have a front end debt to income ratio and you have a back end debt to income ratio. This front end is going to be your mortgage payments. So your principal, interest, taxes, and insurance is your front-end debt. That number over your monthly income is 1 ratio. Then we'll have our back end, which is now all of this debt, your principal, interest, taxes, insurance, plus car payment, student loans, credit card payments. All of that is now added together, and then you have the second ratio divided out with your monthly income. So an FHA loan, you can go up to 56%. On the back end, front end, you can go to 46%. Conventional loan, you'll be 50% on both. And so it's just managing that. And again, you're going 56% or 50%. It is your pre-tax earnings. So it's not what actually goes into your bank account. It's what you earn before everything is taken out of it.
I got another misconception real quick, and it's related to this, and it's not in our list, but it has to do with debt. Mm-hmm. And I'm not sure if this is a misconception or not, so I'm kind of going to put you on the spot right here. But I've heard lenders don't necessarily look at medical debt or health bills and all that. They don't look at that. Is that left completely off, or how does that work?
So it used to be included, but there was some legislature that went out and it's removed completely. So we can see it a lot of times on a credit report. It depends on how the credit report is ran. Because I'm like, I have seen medical debt on a credit report that we've run before, but it's not included in that debt to income ratio.
So that's good. I know medical debt is a huge thing right now. Health insurance is crazy. A lot of people don't have it. You get in that one accident at home, you break a leg, and all of a sudden you've got tens of thousands of dollars of medical bills. So good to know. That's not included when you're applying for these mortgage loans.
And then even people talk about student loans as well. And it's like, okay, how much of my student loan is marked on my monthly debt? Because a lot of times you're not making payments if you're still in school. A good rule of thumb is 0.5% of the balance is what they're going to factor in as what your payment would look like. So if you're looking at Okay, I know I have the student loan. How much is it actually going to hit me? Think of 0.5%.
So it's not necessarily the amount of debt you have, but more of your monthly payments on that debt.
Yeah, that's ultimately all it's going off of is your monthly payments. And again, your credit card minimum down payment, not down payment, but minimum payment.
Minimum monthly payment.
Minimum monthly payment. Again, I would never recommend that. Just pay off your cards and don't pay interest on things.
And we'll talk about credit cards here in a minute.
Yep.
But that's another one of our misconceptions. But let's go to number 4. Number 4 misconception. I make really good money, so I'll definitely qualify.
Yeah. So this one's fun. When we do our online applications, it gives people the opportunity to fill out their finances, what they're making, their work history, right? All of that good stuff. What people don't understand is their earnings and qualified income is very different. So it depends on how you're paid. It depends on how often you're paid. It depends on the type of employee you are. So if you are a 1099 employee versus a W-2 employee, it's looked at different. If you were a W-2 employee and you're now a 1099 employee, it's not the same. So a lender is going to look at how you're paid, when you're paid, what type of payments you're receiving. So the easiest people to qualify, the easiest one for you to look at your pay stub and know, okay, this is, because again, there's calculators online. So we'll get that all the time. Well, I did a calculator online and it said I was qualified for X. I'm like, ooh, well.
A lot of times those mortgage calculators don't put in there the taxes and the insurance part of it, only the interest and the principal.
Yeah, and you're looking at your income as a whole. So if you have someone that makes overtime and bonuses, we actually can't take those at face value. So the only thing we can take at face value is if you're a salaried employee or if you're an hourly employee working consistent hours. So if you're receiving any type of overtime, if you're receiving any type of bonuses, that's going to be an average over a 2-year period. And then you take the most conservative number. So you could have had a killer month in, August. You could have had a killer month in July, but we're not going to take that killer month in July. We're going to take an average of the last 24 months.
Yeah.
And then also you'll get people that are like, well, I'm working 2 jobs, so I have income from both. Well, on an FHA loan, if you have any gap in employment, guess what? You can't use both of those jobs. You're now only using one job. So you have to be consistently working both of those jobs for 2 years. And again, any gap, you're talking, say you have a 6-week gap, we no longer can use both of those. Like sometimes there's ways around it. So qualifying income is going to be different than what you are earning on a monthly basis.
And using that one big bump month is actually going to protect you if you don't use that. You use the 24-month period because say you don't get that again. All of a sudden, oh my gosh, now I've got this big payment I can't afford. So it's good to do that 24-month.
Yeah, it's why you're
24-month average.
Yeah, why you're taking, and again, you're taking the most conservative value.
Right.
Because you want to get people in. The goal of home ownership is to keep you in your home. We never want to set you up for failure. Where it's like, I don't want to put you in this house if you are barely scraping to make it in, because it's like that doesn't serve you. It just stresses you out, and home ownership shouldn't be that like that. Yeah.
We don't want to make it too easy. I mean, we had the 2008 thing where it was super easy to get into those homes mortgages, and look what happened, right?
And
it crashed. And so it's good to do more conservative. Now there's regulations also and all this stuff where you can't do that anymore.
Well, and underwriting has cracked down a lot. Like loans are a lot harder right now. So I have not been in the industry for 30 years. I have people that have been in the industry for 30 years and we're talking about it and they're like, oh, yeah, mortgages are not fun.
Compared to the past.
Yeah. Like they happen, they work all the time. And they're really unique because I think it's just different because people get paid differently now.
I want to change it from harder to safer.
Yes. They're protecting you better.
Yeah. It's not harder to get the loan. It's now safer to get the loan.
Yes.
It's different than the past where it was very easy to go under. You go into foreclosure now, where now it's safer.
Yeah.
The
Because
regulations are more strict because we want you to be safe. We want to have you keep that home. We want you to build the generational wealth where in 20 years, 30 years, when you sell the home, you've got money to retire on now.
Yep.
Which is what my retirement package is, my real estate.
Yeah. It makes a huge difference. And again, so you'll get that where people, so if you are thinking of buying a house, just keep that in mind when you're making a job change. If it's, okay, I want to buy a house sometime in this year. I have the opportunity at work to go from a W-2 employee to a 1099 employee. Well, I'm still employed by this happens. I'm still employed by the same company. I'm just going to go 1099.
Which happened to me, actually. That's my job. I did that exact thing when I bought my house, too.
Yeah. And you're like, no, just wait until you close and then you can change.
It got a little bit scary when it happened. But yeah, we made it work and I did get the house.
Yeah.
This was 12 years ago, but yeah.
Well, and you can, it can work. Like I had a client that they had, he was W-2'd within the last year. So he had a full year of 1099. And we were able to make it work.
That was the same with me. I was about a full year of 1099.
Yeah, but again, then you're taking your year of earnings on a 24-month average. So it changes your earnings quite a bit.
And I had to get a letter from my employer saying, we really love Micah. We've been working with him for a long time. We're going to continue working with him. And that helped underwriting, saying, okay, this guy's good.
Yeah, so it just adds a layer of, just another layer, right?
Yeah.
Like it is what it is. It adds a layer. And we deal with that as it comes. But again, if you're thinking about buying a house, maybe just pause with the type of employment. Like maybe don't make any jumps until you talk to someone.
Yeah, that's what I was going to say. Talk to Holly first and then make your decision which way is the best way for you to go.
Mm-hmm. Yeah. Or, okay, briefly. 1099 employees, we get this all the time. They want to buy a house. 1099 employees are notorious for writing off everything. So if you are a 1099 employee, we don't look at what you actually earned. We look at what you told the government you earned.
Yeah, I made that. I don't know if it was a mistake or not. I tried to refi, but I wrote off so much stuff that I didn't qualify.
You showed you had no earnings.
And then I told my lender, I was like, why didn't you tell me this? Like, we can't tell you this. We can't. You got to do your own thing.
Well, yeah, because I'm not a tax accountant.
Right.
Which is why when I have, like I said, I had a client where it was that discussion where it's, hey, I'm 1099. What do I need to say I made in order to qualify for that? We can look at numbers.
When I say the lender couldn't tell me, it was the lender couldn't tell me how to do my taxes.
How to structure it, yeah.
How to structure it, exactly.
That it's, we roughly know you need to, in order to qualify for this payment, you need to have been earning this. This needs to be your average. However you do that on the back end, talk to your accountant.
Yeah, so not to say that Holly won't give you information.
Yes.
I'm not saying that.
Yeah.
What I'm saying is that they can't tell me how to structure my
I will
taxes,
send you to an accountant
because
I did not get my CPA, and I don't want my CPA.
Right. So, yeah, I just wanted to clear that up. She will tell you everything she can, just not how to do your taxes.
But yeah, that's a big one is you'll get people that are 1099. And they're like, I make great money.
Yeah.
Like, well, you told the government you made a third of what you actually
I thought I was saving money. And in the end, so that's again, talk to the CPA, talk to the lender. Which way is the best route? Because I thought I was saving a ton of money by just writing everything off. When I look at it from a different perspective, if I would refi into a lower rate, I probably would have saved more money going that route instead of writing everything off.
Because, it's going to be very dependent. And again, it can be a short period of time where it's like, I did great in 2024. I'm just going to show this total earning in 2024. Yes, I'm going to get hit with taxes. But this year 24 is going to be enough to utilize that as my 2-month average. And it's going to be okay, and it will work out. So it's again, just being mindful about that. If you're that type of employee, if you want to buy a house within the next year to 2 years, just be mindful about what you're writing off.
Sounds good. Good stuff to know. All right, let's go to the next one. Number 5 misconception. Should I close old credit cards to improve my score? So here's the credit card question. I hear this a lot too. Should I close? And I've had people do it. I closed my credit card, so I think my credit should be great now. Mm-hmm. Hold on. Not necessarily.
Yeah.
Credit cards are both good and bad. So kind of explain the credit card situation.
Yeah. So credit, people feel like they're going to have great credit if they aren't using their credit. Where it's like, I don't have any credit card debt. I don't have a car loan. Like I'm going to have great, my profile is going to look amazing. And you have to use credit to have good credit.
Right.
And so
that's what they call it, a credit score,
yeah.
right? I don't have credit. No, I don't use credit score. It's a credit score.
I use my credit responsibly.
Right.
And so there are things that come into play with everyone's credit, and credit is tricky. Credit scores are tricky because they're different for everyone. A credit pull is going to affect Micah differently than it's going to affect me. It's going to affect your spouse differently than it's going to affect you, which is really interesting when you're co-borrowers. It's like, oh, I didn't realize it was going to hit us differently. Length of open accounts matters. Like your average length of your accounts being open matters. So if you have this card that you got when you were 18, just leave it, but you don't use it anymore. You don't even know where the card is. Keep it open because it's going to help your average length of accounts. And you'll get people that are like, well, I just opened up this, and this because I wanted to have a higher credit like available to me. So I am showing like a smaller utilization. When you open up those accounts, it kills your average. So your average now is shortened. Again, for someone with a 20-year history, it's going to affect them less than someone with a 3-year history. If you have a 3-year history and you just opened up a new card, it's going to hit you hard. If you have a 20-year history and you open up a new card, probably not going to do a ton. Like do very much to you. So it's understanding your own personal credit profile because it's different than anyone else's.
So if you're thinking about cleaning up your credit, first talk to a credit expert. Mm-hmm. Talk to the lender and just get the information first before you decide to open, close, pay off, pay down, different things with these credit cards. And I hear maybe another misconception you can clear up on this one. I heard with credit cards, you want to kind of keep a 30% balance in the credit card. Keep it there. Don't necessarily pay it all off, and don't take it to the max, but kind of keep something in there to build credit better.
So just don't ever use more than 30%. Ideally, like I said, you're using and paying off every single month.
So that actually works better if you pay the whole thing off than keeping a balance in there?
Yeah, I wouldn't ever because you keep a balance, you pay interest. So, but on your monthly utilization, again, say you have a $100 limit, don't ever use more than $30. And so that's also a common one where people, you have access to credit increases. Like
real quick, when you say don't use 30%, can you use like 70%, but then pay it down to 30% that first monthly payment?
You can.
Is that a good idea, or just keep it right at the 30? Don't ever get to the max.
Ideally,
if you're going to pay it down.
Ideally, you're never using more than 30% of your credit, like available credit. Which is why. So sometimes what's helpful is if you have a credit card, a lot of people are eligible for limit increases. And people are like, well, I don't want to increase my limit because then that just makes me nervous because what if I'm using it? And it's like, well, just increase it, but don't use it. Because again, so ideally you're never using more than 30% of your credit. And so if you have a $100 limit, but you're eligible for a $1,000 limit, guess what? Now your utilization is $300 versus that $30, all on the same card. It's still going to look like a 30% utilization, but your available credit was just increased. So that's more what, if you are needing to utilize more than 30% of what your available credit is, look at increasing your credit amount versus going over that 30% of usage. Because over 30%, you get hit harder. Where it's like, just get yourself more credit available.
Yeah, and then with credits, you do the soft pull, you look at their credit, and say the credit's not looking the greatest. We need to work on this. Do you have steps or programs you can recommend to the borrower to help them bring that credit? Is there like a program you can put them on, or refer them to someone to help them bring that down?
Yeah, so we partner with, and by partner, I don't get paid on it. We've done our research with credit repair companies. A lot of them can be very expensive. There's someone that we've found that his pricing is really affordable. He does a soft pull at the beginning and will do a personalized video for you. And even at that, where it gives you suggestions and it's either, you're eligible for this whole credit repair program, or, based on what we're seeing, if you did this, this, and this, it's going to help you improve. And so, again, we can refer you to that person because it is, again, I'm not a credit expert. We actually are having someone come in and do a CE course on credit for agents because I think it's important because credit's wonky.
It's a whole different.
Well, it's a whole different beast and everyone's credit is affected differently. But the bulk of it is make your payments. Late payments really hurt you, especially in 90-day late. Don't ever go 90-day late. They really, they hurt you more than anything else. Well, not more than anything else, but a lot. They hurt you a lot, especially on an installment loan like a car payment or a house payment. A 90-day late is going to affect you. But again, utilization, use less. And again, if you need to use more, try and get an increase on cards you already have versus going and opening up more cards.
What about credit that's been paid off, like a car loan? Mm-hmm. I've had a 5-6 year car loan and I paid it off. Do you go back in history and look at that car loan, or how does that?
It will show as a closed account, so it's not going to necessarily factor into your today credit score.
But it won't hurt it either because it's closed out.
Yeah, because it's closed.
Okay, perfect. So that's credit card misconceptions, and there's probably quite a bit of that we could.
Yeah, that's well, and I'm like, yeah, you could pull in a full credit expert and talk about it, and it's still because. Again, we'll get people and they're like, well, I just did my credit. I just looked on Credit Karma or a lot of people's credit cards on their apps let you do a FICO score.
Yeah.
They're like, this is what my credit score is. Mortgage looks at a different score.
It's different algorithms, right?
Yeah.
So if you're looking at a car loan versus, the RC Willey furniture credit versus a mortgage credit, they're going to look at completely different algorithms to qualify you.
Yep. So they run 3 credit bureaus. They run Experian, Equifax, and TransUnion. And it's ran off of, I think, FICO 2 or 4, which is just different than what you're seeing online.
Yeah, that's good. That's another, I guess, misconception as well. We could have covered the FICO scores.
Yep.
But again, if you got credit issues, give us a call. Reach out to us. We'll put you in the right direction.
Well, and again, 620 is kind of going to be your baseline. If your credit score is lower than 620, you probably need help. Getting you to a point where you're going to be eligible. And
depend on everyone's situation too. That help could come real quick. We could clean it up real quick, or it might take a few months to get it done.
We had someone that was in, I think they're taking the average, the middle average score, sorry. So like you have these 3 scores. This one is 700. This one's 710. This one's 705. Your score is 705.
And if there's multiple borrowers,
you'll take the
middle of the lowest.
Yep. And so we had one, and his middle score was 6 something, like lower 6s. And by the time they purchased, we were at an eligible point, which was 6 to 8 weeks.
Yeah, so it can be done quick. Yeah, and depending on everyone's situation, depending on what your credit's looking like.
Yeah, absolutely.
Everyone can be cleaned up. First of all, it can be cleaned up. But it's how fast we can get that done depends on your situation.
Yeah, if you have a lot of late payments, that a lot of times is just time. You're going to need time to separate yourself from those late payments.
So that you're better now.
Yeah, and that doesn't mean that it's going to take a year. It just sometimes takes more time than someone that is using 50% of their credit card. So it's just going to be different.
Every situation is different.
Yep.
All right. So that was number 5 misconception. Let's go to number 6 here. Number 6 misconception. FHA is only for first-time home buyers. We kind of covered this before. Yep. Let's get a little bit more into that. But FHA is only first-time home buyers. Yep.
Anyone can use FHA. If you have more down payment, probably don't use FHA. An FHA loan, you don't get out of mortgage insurance. You have to put a minimum of 10% down originally to even ever be eligible to get out of mortgage insurance. A conventional loan, once you hit that 20% equity in the house, mortgage insurance is going to come off. So again, if you have a higher down payment, we're probably going to put you into a conventional product anyway. Even if you're a first-time buyer, we're probably going to put you into a different product. But FHA loans are not for just first-time home buyers. You cannot have 2 FHA loans at the same time. The way you qualify is going to be different if you have a conventional loan and then you want to go get an FHA loan. It's going to look different. But anyone can use them.
Yeah.
And
So why does FHA loans seem so wonderful? Like,
They're
well,
interest.
I guess they're good, but there's, I guess, pros and cons to both
Yeah.
conventionals and FHA.
Yeah,
So what are the pros and cons for an FHA?
So an FHA loan is going to start with a lower interest rate. So people will see an FHA rate and they're like, I want to go that way. That makes the most sense. And for a lot of buyers, it does make the most sense. An FHA loan also has mortgage insurance, but they finance mortgage insurance up front. So you'll have your mortgage insurance payment, and then you will also have a lump sum on your closing fees that will get wrapped into your loan. So your loan value will go up. So say you were purchasing a house and your loan value is going to be $500,000. Well, we actually are ending at like 505 because that mortgage insurance is getting financed in. But again, that lower down payment option and lower interest rate results in a lower payment for a lot of people. Other times you'll look at a conventional product and the interest rate is higher and people just automatically assume, okay, my payment's going to be higher. It's not the case always. So it's just important to explore both. Again, if you're a borrower and you have above a 700 credit score, we're probably looking at conventional.
I think the biggest one between the two is just that mortgage insurance, right? It's like you want to pay that mortgage. So with FHA, is that the life of the loan you're paying that mortgage insurance? Versus a conventional, you can stop the mortgage insurance after you've built 20% equity into the home.
Yeah. Unless if you put at least 10% down on an FHA program, you're eventually eligible to get out of that mortgage insurance, but no one's sitting in an FHA loan long enough.
Right. So I was going to say too, is maybe you start out with the FHA loan.
And then you refi.
And when the time is right, you refi into the conventional. Get rid of that mortgage insurance.
Yeah, and you can do that. It's about a 6 month. You have to make 6 payments. Mortgages, you don't make that first month payment because you pay for your interest and those types of things at closing. You have to make 6 payments, and then you're eligible to refinance on your loans.
Depending on when in the calendar you buy on that FHA, it can be anywhere from 7 to 8 months. You can refi into a conventional.
Yeah. And so, if your credit score is lower, then it's maybe start this way, then we refi you into something different.
Again, so many different ways, so many things to do.
Very, very personalized.
It's just not a one cut and dry kind of thing. This is the way you do it. There's so many different routes to go. And again, that's why you come talk to the experts. And don't listen to these misconceptions.
Yeah. Don't get it in your head and don't ask questions. Like, ask questions.
Yeah. I had a boss back in Hawaii. Thank you, AYK. We call him AYK. I had a boss back when I lived in Hawaii and I worked for him. He was always, never guess. Always ask questions. Never guess. And that was the biggest thing I learned from never guess. Always ask the question. And there's never a stupid question.
Yeah, no. Never.
No. Because, that same question you may feel like it's a dumb question. I don't know this. But you know what? There's thousands of people that are feeling the same way. Like, I don't want to ask that question because I feel stupid. There's no stupid questions.
Well, and I'm like, we have agents that have similar questions.
Yeah, I still have questions.
Where they're like, oh, I didn't realize that you can, like, that big. That's a big one. If you haven't owned in 3 years, you can go get a new FHA loan. And people are like, what? I had no idea.
And I heard that before, but I kind of forgot about it.
You forget about it if you aren't doing loans every day.
Yeah. So that's a good reminder right there. So let's go to the next one here. Number 7. So we talked about FHA loans. Let's talk about VA loans. Misconception number 7. VA loans are slower or harder to close.
They can be. But they also can be really smooth. It's going to depend. Again, I think the general overlying theme of today is it's going to depend on you as the borrower and what your profile looks like. I just closed a VA loan. It was maybe a 3-week close. And it was totally fine. We had no hiccups. We had no issues. You can have other VA loans because the thing with a VA loan is in a typical transaction, you can rush an appraisal. You can rush some of these things. On a VA loan, you cannot pay for a rushed appraisal. So you're kind of at the constraints of that. Like, I can't do anything about it. You can't do anything about it. We're just stuck. So if you have a buyer that's purchasing a VA is going to have similar requirements as like an FHA loan, which during that appraisal period, they're looking for specific things. A conventional loan is a lot more flexible than these other 2 programs because these are these government-backed programs. They want to make sure the houses look a certain way and have these certain components to them. So say something happens in this appraisal that then needs to be repaired before we can close. We're stuck. There's nothing I can do about it. So it can sometimes be longer. It's going to be the same way with an FHA loan. It's going to be the same thing with a USDA loan. You get kind of handcuffed to a situation that's out of your control, which can be a hassle. But again, you can have some that are super clean.
I want to expand on that a little bit, but real quick first, VA loans. Again, no stupid questions. You might not know what a VA loan is. VA is Veterans Administration. Is that correct? VA, Veterans. I know it's Veterans.
Yeah,
I'm not sure what the A is.
Think so. I don't know.
And to get a VA loan, you have to have served in the United States military. Is that correct? Is there other ways to qualify for a VA loan, or is that the only way?
Yep.
You have to be a vet.
Yep, you have to be a vet in order to qualify. We'll have this question where you were married to someone and divorced. Do you have access to a VA program? Nope, you do not. It stays with the vet. VA programs are great because you can do a 0% down payment. Your qualifying income is looked at. Well, qualifying income is looked at the same, but we don't look at DTI. Your DTI can basically be whatever you want it to be, as long as instead of a debt to income, we're looking at residual income, which is a very different thing. So there is a certain amount of your income that needs to be available after all of these purchases are made. And that's what we look at. We don't look at a debt to income ratio the same way as we would on any other loan. So they're extremely flexible. They're great programs. VA rates are usually lower than a lot of other programs.
So it's our government's attempt to take care of our veterans.
Yeah. So if you are eligible for that, definitely explore it.
Yeah, and then I wanted to also, on the VA, you talked about you might not qualify in certain situations, repairs. Now, this is where you need a really good real estate agent.
Yes, absolutely.
To show you the correct homes for these, because VAs, FHAs also, but not as, I don't think as strict as the VAs. If there's some safety issues with that home, if it's not livable, like you're looking at a flip, you can't do a flip with the VA. You can't do something that's going to need some major work done. If there's safety issues, I've had things like, handrails on stairways. That's got to be there. Sometimes homes, maybe you'll qualify in a conventional if it doesn't have that that handrail, but on VA they're going to want you to have that handrail on the stairs. Different things. So you make sure you get the right agent to show you the proper homes, that you're not going to fall in love with some home that doesn't qualify for a VA.
Yeah, because there are certain ones that, and even like silly things, like your water heater has to be double strapped. That's going to be FHA or VA, right? Like, and you'll walk through and it's, oh, I know for sure, which means someone has to come back out. Like, you're going to have this initial appraisal. Someone has to come back out, which just extends your...
So it's not impossible to get these homes. But
they can...
But we got to make sure we're approaching it the right way.
And making sure you have the right expectations in terms of timeline, and this is what we need, this is...
And your buyer, or your seller, the seller of the home, is willing to work with you on this stuff as well.
Yep, absolutely.
So, it's you got to have great communication with the seller's agent. The buyers need that to make sure your VA goes through smoothly. And then the other thing on with the VA loan, I think the only other difference I've noticed with VA is a termite inspection. You need a termite inspection, where the other loans you don't need that.
Yep.
So, but that's simple stuff. It's easy.
Yeah. No. And again, we can do them quick.
Yeah.
Like it is going to depend on the house. It's going to depend on the borrower. They can be a hassle, but they're fine.
Yeah, VA loans are great, and we've done many of those VA loans, and salute to our veterans out there. Thank you.
Yes, thank you.
All right, next misconception, number 8. Put my glasses on here. Our 8th misconception: the mortgage payment is just the loan principal and the interest. So we kind of talked about with these online calculators. Yep. A lot of times these online calculators only show you the principal and the interest, and maybe that's where the misconception comes from. Like, it's more than just principal and interest.
Yeah, so it's required by most lenders, especially with lower down payments. Your mortgage payment is not going to just have your principal and interest. It will have your principal, interest, taxes, and insurance. These taxes and insurance are called, you'll hear this, it's kind of like this word you'll hear frequently if you're looking at a house, if you've owned a home, is your escrow account. So your lender will take these taxes and insurance, you're talking about your homeowner's insurance, and they will put this money, you'll pay it every month, and it will sit in a different bucket. And this bucket then at the end of the year goes and pays your homeowner's insurance bill, and it pays your tax bill. It's required by lenders, like I said. Sometimes you're able to opt out of an escrow account and you can just pay those bills by yourself.
Which I don't suggest.
Yeah, I was going to say people forget to pay them. And again, having this lump sum payment of hitch of a $4,000 tax bill at the end of the year, they're doing October, November.
Yeah.
And guess what? It's also Christmas and you are doing all these other things.
You just had that medical emergency.
And if you don't pay this tax bill, your house can be foreclosed on.
Yeah.
Right? So it's easier where you're paying a couple $100 a month into this. Your lender is taking care of it. They're paying your insurance company. They're paying the county for your taxes. But yeah, so that it's called PITI. That's your whole payment. You'll also have a homeowner's, depending on if you're in an HOA, you'll have a homeowners association due as well. That does not get paid by your lender, but it is included in your debt to income ratio. So if you are looking at a house with an HOA, your PITI, we also include your homeowners association.
HOA fees. Gotta love those HOAs.
Yep. So we'll throw that into that number as well. Again, your lender doesn't pay it for you, but I include that when I'm saying your mortgage is going to cost you $3,800 a month. I'm including your homeowners association fees.
And to kind of piggyback off that HOA thing too, is like, single family homes a lot of times don't have the HOAs. Townhomes, condos have those HOAs. So your qualifications for the loan amount will be different versus a townhome and condo versus a single family, because now we've got to add those HOA fees into it.
Yeah, absolutely. Especially with condos. Condos are notorious for having very expensive HOAs, which isn't a bad thing. A lot of times they're providing services. And your insurance, usually your HOA, if you have a larger HOA fee, a lot of times it's covering the bulk of your homeowner's insurance as well. So your homeowner's insurance policy is going to be significantly less expensive if it's wrapped into your HOA. Condos, it's wrapped in. That doesn't mean you're not going to have like a little separate policy, but that's something to just be aware of because it will change your...
Yeah, and there's different HOA fees. I've seen $20 monthly HOA fees and I've seen $300 monthly HOA fees. And depending on what those cover, it can cover, like the $20 one was just to maintain the walkway, the hiking
trail
walkways,
or something.
Whereas the $300 one, you're getting water, sewer, garbage pickup, snow removal, outside maintenance, landscaping. Sometimes you get internet or cable is included in that HOA. So again, each HOA is different. It's not necessarily a bad thing.
Yeah, so
clubhouses, courts, swimming pools, again, depends on
fitness centers. Yeah, so it depends. Like, if you see this huge HOA payment and you're like, oh, I don't want to be there, see what it covers. Because a lot of times it has good things.
Talk to your agent with that one. Your agent will figure that out for you. Title companies are good at also pulling the HOA and finding out what's going on with the HOA. So I was going to say, with that one, just the principal and interest, I hear this all the time from my buyers. When we get to even at the closing table, they'll see that, okay, this is your insurance and this is your taxes. Oh, do I need to make those payments too? Even at the closing table, and that might be my fault. I don't educate my buyers enough, and I do sometimes. Sorry, I do sometimes. I've done this so many times. Sometimes I gotta remember, buyers aren't. This is their first time. Yeah, they've never done this.
Yeah, if you haven't done it, it's a lot. Just
so I hear that all the time. All right, next one. Number 9. Number 9 misconception. I'll wait until rates drop to buy. Okay, this is a huge one right now. Everybody's waiting for rates to drop before they want to buy.
Yeah.
Is that good or is that bad?
I just get in. My whole thing is I don't pay attention to rates. My goal as a mortgage broker is to have the interest rate cost you nothing, right? I don't want it to cost you anything. So what does that mean? It means we look at today's rates and we pay more attention to your payment than the interest rate. I don't care what the interest rate is. Not that I don't care and I don't want to be sound callous towards it, but if you're comfortable with the payment, let's focus on the payment because an interest rate can go up and you're super grateful that you purchased, or it can go down and you refinance anyway. And again, that sounds casual, but if you're comfortable with that payment, then anything else is just cherry on top. Again, those clients that we worked with, they qualified at today's interest rates. getting them a lower interest rate was this cherry on top where
Right.
it's like, great, this eases me into home ownership.
And just because you qualify for that, it doesn't mean I'm going to try and get we're going to try and get the rate down even more.
Yes, like I want it to be as affordable as possible.
Yeah.
But it's, don't get so hung up on the interest rate because you have no control over that. You will never have control over that. And so it's taking advantage of the market that you're in. That's what it's, a buyer's market.
Yeah.
Take advantage of that. Like, let's go get you credits to lower this interest rate, or let's get you credits to pay off your closing fees and keep more money in your pocket. But let's really just focus on your payment. What does your payment need to be? Is it a realistic number for the area that you want to purchase in, the type of home that you want to purchase in? If those are yeses, then who cares?
And the real popular tagline or quote or whatever you want to call it right now is marry the price, date the rate.
Yeah,
right?
marry your mortgage, date the rate, marry your mortgage. And even that, I'm like, ugh.
And it's cheesy. It sounds cheesy, but what it basically means is rates are going to go up and down.
They'll fluctuate.
And right now, where they're at right now, everyone's pretty sure they're going to come down sometime eventually, right? One thing we can't control, or we don't know, or we do know actually, prices are going to continue to go up. They do every single year. I mean, there's only 2 years since they've been keeping track of it, that prices actually went down. But every year they've gone up in the almost 60, 70, whatever amount of years they've been keeping track of this.
It's on average. I think it's over a 5-year span or a 6-year span. I mean, it's an insane amount that houses have continued to show appreciation. And the one thing that's unique with Utah's market is Utah was ranked the #1 state in the nation 2 years in a row. And some of the metrics that went into that are the fiscal stability and the economic performance of the state. Utah's market is good. It's robust. It's going to continue being good and robust. Yes, there's pockets that are maybe not going to appreciate as quickly as other areas, but real estate in Utah is pretty safe.
And I'm a little bit split on the Utah thing because I bought my house at the perfect time, so I built a ton of equity since I've had that. Prices have just went up so crazy here in the Utah market. At the same time, it really hurts when people are trying to buy. So it's hard. And maybe this is a misconception as well, but we've talked about it in our sales meeting a few times. Predictions over the next 10 years, the median home price in the Salt Lake area is going to be close to $1 million.
Yeah. And again, which I look at my kids and I'm like, how are you ever going to buy? Yeah. But then I also look at buyer profiles, and just the difference for me graduating college to now, like I look at what high schoolers are making and I'm like, I made that as a college graduate. So things do change and change quickly. And I think for people who want to purchase a home, there's always going to be the opportunity.
And one thing about the real estate industry as well is that we adapt.
Yeah,
we find
absolutely.
ways. When something happens and they throw a wrench into the system, like, I got this, and we adapt. Lenders adapt, agents adapt. We adapt to help our clients to make it affordable, to find ways to make it affordable.
Yeah,
so
to help get
it's not
you
the
in.
end of the world. And again, if you're thinking of buying, it's always better to buy now. I know you want to wait till the rates drop, and this is the majority of buyers right now. We want to wait till rates drop because we need the monthly affordability. We can drop them now. We'll get them, and we can refi you into that permanent rate later. So
let's focus.
Marry the mortgage, date the rate.
Let's focus on your payment, and then we'll deal with your interest rate.
So say we get that 2-1 buy down. You're paying, like with our client, they paid $600 less right now currently that first year for their mortgage payment. Rates drop to a place where they can permanently get into that rate within a year, 2 years. We do that. They saved money up front, and they've built this equity into the home. Where 2 years down the road, they've built some equity.
Yeah,
they don't have to go buy now.
Yeah, they're in a place they wanted to be.
Right. So it's the long-term vision, the long-term goal you got to look at, not the short-term stuff. You look at the short-terms, you're limiting yourself.
Yeah, which is what, again, you need to be realistic with your expectations as a home buyer, where it's, okay, I'm looking at this townhome, I'm going 100%, I want no down payment. I'm doing down payment assistance. You're going to need to stay in that house longer than 2 years to be able to sell that house because you don't have the equity. You didn't put the equity in. And so there are fees associated with buying and selling homes. And so it's being realistic with what your goals and expectations are, where it's, okay, I'm going to sit in this house for 5 years, or I never intend on selling this one. I'm going to use it as a rental,
Right.
and then I'm going to go get another one.
I'm
So
going
it's
to leave it to my children.
yeah, so it's okay. I'm going to sit with, I didn't put a down payment on this, and it's okay because I can make the payment, and I never intend on selling it. Because again, there's that misconception of, oh, I got into this house, I'm going to have equity. I can go sell this house, and I can go do something different.
Mm-hmm.
If you don't put any money down, there's no equity in it.
Well, it's not just a house you're living in. It's generational wealth that
Yes.
you're building.
Mm-hmm,
Not just for yourself, your children, and so on. So, me and my wife, we've got we're one child, plus our grandkids. So when it's time, we make the decision. Are we in a place where we can leave it to our child, or do we want to cash it out and use it as a retirement? So there's,
There's different avenues
yeah.
to utilize it.
Right on. So
We're almost there.
Where are we at now?
Number 10, I think.
Number 10 misconception. Number 10 misconception, pre-qualified means I'm guaranteed a loan. So you get this all the time, especially when I'm working with buyers. I get a pre-qualification letter from you.
Yep.
There's the pre-qualification, which is a little bit easier to get than a pre-approval.
Yes.
So let's talk about pre-qualification, pre-approval, and how we get to the closing table without.
Yeah. So we'll get this frequently with people where it's, I'm already pre-qualified. Well, what does that mean? And so I'll start talking to clients. I said, well, did you submit any documents? No, I didn't submit any documents. Okay, that's going to make a difference. Because again, we talked about income. What does your income actually look like? What is actually qualifying income? So a pre-qualification is based off of the information you tell whoever pre-qualified you. They don't do any additional research. You take it at face value, which is fine. But it can lead to disappointment. No. It can lead to transactions that don't work. It can lead you to looking at houses that you actually aren't qualified to purchase. And I'll tell you what, if you're looking at a house that costs $500,000 and then you're told your budget is $300,000, suddenly these houses that you would have been happy with in the 300 range because you're like, sweet, like I'm getting into this house, I'm really excited. You don't want because you were looking at houses that were $200,000 more expensive than that.
Yes.
So a full pre-approval is going to be full pre-approval is we're doing a hard credit pull. We're doing a hard credit pull. You've submitted your income statements. You've submitted your 2 months of bank statements showing your down payment. And we've ran what's called AUS or an automatic underwriting system on you and on your credit profile. When we get a yes on that, we know you're golden. Yeah. This loan is going to close. We know exactly what we need to do to make this loan close. It's good.
We've actually went through this with our last.
Yes, with our last client. Yeah.
Real quick though, so when you're filling out those applications, it's very important to be very honest with it. I mean, it's easy to kind of exaggerate a little bit because I really want this house. I made a little bit more than I'm actually doing, or maybe you got a bonus or overtime this last month, and so you're going to call. You're say, "Hey, I made a ton of money last month." Again, the 24-month average is what we're looking at. So it's very important to, first of all, be honest on those applications. Yes. It's only going to hurt you if you're not.
Yeah, and it will hurt you.
Yeah.
It will frustrate me.
Yeah.
It will frustrate. But again,
the buyer.
It puts you, the buyer, in a really tough spot.
Yeah.
Again, I do whatever I can because again, you have one where it's like, oh, I had no idea.
Yeah.
This was going to get pulled up,
and I've seen
in more due diligence.
Yeah.
Which is why I don't love pre-qualifying people. I like to pre-approve.
Let's talk about the pre-approval. So on our last transaction, I had a client, a buyer. We both had our client that fell in love with this home. Just loved it. I mean, she was like, this is the place. It was a little bit more than they wanted to spend, but they still qualified for it. But it was a new construction home, and Holly matched the fees they sent, or the incentives or whatever. She was just as good as the builder's lender. So go to Holly; she'll make it work. But anyway, so
but the builder didn't want to qualify him.
Well, the builder didn't want to qualify. Yeah, so the builders. Well, that's another thing too.
They're the builder's lenders.
The builder's lender didn't qualify them.
They said we can't.
Holly's
do this.
like, why? I qualified them. Anyway, so we went to Holly. She matched all of them. She did qualify them, but they wanted $10,000 down payment, non-refundable within 3 days.
Yeah.
So each builder's different. Not all builders do this. Each builder has their own way of doing things. This builder that they chose was a excellent builder.
Yeah.
A great builder.
Beautiful home.
Top of the line builders.
Yes, love it.
Top of the line finishes. I mean, one of the top builders. So, but they want $10,000 down, and it's non-refundable in 3 days. These are my first-time home buyers. They've never done this before. $10,000 non-refundable in 3 days is very scary.
Yeah, it's scary.
Right. So we went to Holly. Yeah, they pre-qualify for it, but let's get them approval first. So thank you so much because you really saved this deal. You went out of your way to talk to the seller's, the builder's agent and say, hey, this is what's going on. My buyers, first-time home buyers, this is scary, $10,000. We need to get them pre-approved first, and it's going to take more than 3 days to get this done. We need documents from the buyers. We need to verify everything. So you went and you verified everything. I mean, maybe you can talk a little bit better about this.
And they actually, we went one step further than a pre-approval. We actually sent them to underwriting.
Yeah, yeah.
And so we sent them, I wanted to make sure we weren't going to have any issues that came up with X, Y, or Z. Because again, I'll get AUS approval, but that doesn't mean, again, AUS, automatic underwriting systems, I'll get approval on that. That doesn't mean an underwriter isn't going to dig into it. So I wanted to give the underwriter everything and say, okay, you dig into this now.
Which they did.
And kick this back. And once you kick it back, I want to see what you're kicking back to me and make sure we can overcome it. Because again, $10,000 hard money is scary.
Yeah.
And so we wanted to make sure that what they were kicking back was workable. Yeah. And it was. And
you did. And your underwriter did kick it back with some
with conditions
and we did that.
And we adjusted it. And
now the thing I want to clarify this also with the so we took more than 3 days to get them to $10,000. Not every situation is going to be like that. So don't think that you can just get away with not putting down payment. We're in a market right now where builders are trying to get rid of homes.
Yes.
They're having a hard time getting rid of homes. So they were okay letting that 3-day period.
Yeah, because no one was on the hills purchasing.
Yeah. Now, if we're in a different market, if we're in a seller's market where homes are just flying off the shelf,
they're going to say no.
We can't do that, right?
Yeah, which again is then being prepared as a buyer.
Right.
And okay, I know we want to do this. We're going to have this all taken care of ahead of time.
And which is another reason why you buy right now, because you can get these kind of deals in situations where it's going to be in the buyer's interest to do it now versus waiting.
Yeah,
so,
absolutely.
So yeah, that was a great thing. That was, I mean, you really pulled that deal through, and I've been a big Holly fan ever since then.
Well,
so
yeah, it was.
And you were really excellent with also reaching out to the clients and really putting them at ease of what's going on, because they were up and down this roller coaster the whole time.
It's an emotional thing, and we will have transactions that are so smooth, and people are like, you don't need to use. I don't need to use an agent. I don't need to use a lender. This is so easy. And then
be careful with that.
And then you're like, wait a minute. You don't realize how much is going on the back end.
There's a lot.
There's a lot that's happening to make it work.
There's been many times where I'll go into a deal going, this is going to be one of the easiest ones I've ever done. And all of a sudden it just completely flips and there's different things going on. There's other times where I'm like, this is going to be a tough one. And
it ends up being okay.
Yeah. So every situation is different. That's why you got to have the experts, someone on your side, making sure you get the best deal and they're going the right direction.
Yeah. And again, they literally, we work for you.
Yeah.
And I think that's
we don't get paid unless you get the place. So
I'm like, here's the thing with a lender and a broker, you can pull out, say something happens with this house and you decide not to purchase it. And I worked on this loan for a month, or I've been talking to you for 3 months. You can pull it out with no repercussions, right? Like, I don't charge you. Yep. I don't say, hey, actually, I've spent this many hours with you. So
just don't do it though.
No, please don't do it because it's a lot of work. But no, what I'm saying is
part of the business.
It's like we aren't trying to be any way, shape, or form predatory. It's like I literally work for you. I want this to work for you. And if it's not going to be on this house, let's go find what you're excited about, what makes sense for you.
Well, not only do I want to work for you, I also want to make a good name for myself. I don't want you to say, I had a terrible experience with him.
Yeah.
I'm using someone else next time. I'm going to refer to someone else next time. No, I want you to make sure you had the best experience. We want you to make sure you had the best experience and that you're happy that you worked with us.
Yeah, and that you're in a place that you feel happy about, that you don't have regrets, that you don't, 6 months down the line be like, oh, I didn't understand this. I'm so frustrated that my lender didn't talk to me about this. My agent didn't talk to me about this. Like, I want to have those conversations so you are comfortable with where it's at. And then the lines of communication stay open.
Yeah. And even if we
continue contacting
even
me.
if we did talk to you about it and you forgot,
call me again.
yes, we're open forever.
Yes.
Call me 5 years down the road and say, hey, Mike, you helped me buy my home 5 years ago and I forgot about this. What happened?
Yeah.
I'll work with you.
Hey, Holly, can you tell me where this paperwork is? Yeah, I can. Yeah.
And I get that all the time too.
Yeah, I can help you with that. Or, hey, I just got this in the mail. Do I need to take care of it? Send me a picture.
Yeah, I got a letter from my mortgage and my mortgage company saying my insurance is not there. What happened? I've had that one.
Yeah. Send it to me. Let's look and we'll figure it out.
And we'll get it done.
Yeah.
So once I've worked for you, I'm always working for you.
We're on your team.
Always. All right, let's go to number 11, our last one. Misconception number 11. I can't shop around for rates because it'll hurt my credit. I hear this one all the time.
Yep.
All the time. I can only get one mortgage, only one credit pull because I don't want it to ding my credit. Misconception.
Yep. Misconception. We talked about pre-approval versus pre-qualification. A true pre-approval is going to require a hard credit pull. I will get people pretty darn close with say, we don't want to do a hard pull, right? Like, I haven't even started looking at houses. I don't want you to do a hard credit pull because they only last for a certain period of time. And I don't know if I'm going to find a home within that window. Great. I'll do a soft credit. I'll do a soft credit check. We'll be able to look at all of your monthly liabilities. I can start looking at your documents. I can get a really clear picture of what your loan's going to look like. But to get a full pre-approval, we need to do a hard credit pull. The good thing with a hard credit pull is if you're within the same vertical, if Holly with Preferred Lender pulls your credit and Jeremy with Zions Bank pulls your credit within a 45-day period, it doesn't ding you separately. They're looked at as the same type of credit pull. When you go into underwriting, they will question the credit pulls. They'll say, what was this? Did any new credit result from this pull? No, we were just mortgage shopping. Great. So you can do that. The one thing that is, I think the biggest misconception with interest rates is, okay, this is what someone's pitching to me. This is what they've told me this interest rate's going to be. An interest rate means nothing until you're under contract. An interest rate means nothing until you have locked your loan. An interest rate can fluctuate several times a day. Once you're under contract, you can't lock a loan unless you're under contract. You can't lock that interest rate until you have a house or you have your apartment, you have your townhome. So it's getting to the point where I kind of know how this bank is going to work. I know how this mortgage broker is going to work. I feel comfortable with the communication here or there. That's kind of where you start. Who do I feel comfortable with? Once you go under contract, then you really hone in on rates. And again, you need to do it quickly because your contract period is a certain number of days. So you get your quote, you're under contract. Now I have a more accurate quote with this party. I can now show this party, hey, this is the quote that I got. Where do your rates compare to that?
Yeah.
Because again, an interest rate is you don't always see the full picture. Sometimes there's costs associated with it. Sometimes there's like, you just don't know until you're under contract.
Sometimes there's hidden fees, not necessarily hidden, just not in sight.
Yeah. So the moral of the story is find someone you feel comfortable with. You feel they're honest. They're not going to lie to me. They're going to do the best for me. And you start working with them. And again, if you then see something on a billboard, hey, Holly, I saw this, or I had a client on a VA loan. I had this bank that was advertising this specific interest rate for VA loans. I said, great. Go talk to the bank. Bring me back what they're doing for you.
It's the good faith estimate. Do they still call it that? The good faith estimate?
And let's see if we can match it. And ultimately, they went to this bank, and guess what? They never even were able to get in contact with anyone. It was like, oh, this isn't going to work. I can't do a loan with someone that's not going to contact me. And so it's finding who you're comfortable with, someone that's going to be honest with you, and then saying, I'm not in the business of taking loans that I don't earn and I don't deserve. So there are loans, especially with new builds. Micah said I had one with a new builder that I was able to match or do better than. There are some builders I cannot do that with. And I will work with a client and I get them to this point and we're pre-approved and I see this rate and we talk about it. I see their estimate. I was like, hey, you know what? it makes more sense for you to go with this other person. I have sent people to
It's usually builder.
builder. Yeah, it's
more times than not.
it's always a builder.
New construction.
Anyone else I'm going to be able
New
to do it.
construction, a lot of times those lenders are just they're working
They're working with the build. They financed the build, they have
they can
different.
take more hits than yeah. And I also want to talk about the banks, credit unions, mortgage brokers all have different fees, all have different structures. A lot of times, like you said, they'll advertise this one rate, but then they bake in all these fees
into the back end.
Yeah,
so you have like higher closing costs that you weren't aware of. And so an interest rate really means nothing until you're under contract on your home.
Yeah.
And again, it means nothing because we don't know what your credit is. It just is.
And don't let that scare you. Like I have to get under contract first to find my rate.
Yeah.
Because again, if you
we're
get to
gonna
the
get
point,
close.
Yeah, we're gonna get close. And if it gets to the point where you know what, we're under contract and the rate's just not working, you're not out. We can always move on to something different. Maybe it's just not the right time.
Well, and again, we're going to get you close.
Yeah.
We're going to be pretty close to what the rate is going to end up for you. And again, that's why let's focus on payment. This is what I need my payment to be. What type of houses are in that range?
And I always suggest to my clients, get more than one quote from a mortgage lender.
Yeah.
Even though, I don't want to take any business away from my good friend Holly here, she'll 9 times out of 10, she'll at least get you pretty close to that or beat it.
Yeah. No, we are, again, a builder's lender is going to be different just because they can do different things, but we almost always can beat. So, but again, we just have to see where the other one is because you have to have fair, lending practices, right? Like you can't offer something to someone that you aren't offering to someone else without cause. And
even mortgage brokers, some of them have different programs where they can waive certain fees where other ones can. Mm-hmm. Again, so it's good to get multiple quotes. Yeah,
where we're able to do certain things that other people can't.
And it won't hurt your credit, those soft pulls.
Soft pulls are going to do nothing. A hard pull, again, keep it in a 45-day window. But yeah, just do your research and find someone that you feel good about.
I love it.
So, yeah.
This has been very informational.
I know. Holly. There you go.
And thank you for
really
joining
probably
me
hit
today.
15 points, 20 points. I don't know.
Thank you for joining me on this. It was a lot of great information. And anyone out there thinking of buying or just even looking at your numbers, I want to buy, but I'm not sure. Let's look at your numbers. It's a free service. She'll look at your numbers for free. Costs you nothing. Don't even have to use her. She hopes you do because she's gonna knock it out of the park as far as service. But yeah, come check it out. Ask us any questions. Leave me a comment if you have any questions for me or Holly.
Yep.
And again, scroll down into the description. I'll leave both of our contact information there so you can reach out to either one of us.
Perfect.
Yeah.
Hey,
well, thank you for joining me.
Awesome. Thanks, Micah.
Thank you.
Good luck, buyers.